This week, senior debt is climbing while inflation accelerates. Is there a way out?
Building relationships is the way Mutual of Omaha has grown into one of the leading financial services companies in the world. Our reverse mortgage wholesale division is proud to carry on this 100-plus year tradition. To your borrowers, a reverse mortgage is more than a transaction. It's a promise of a better, more stress-free life. Our goal is to provide you, our valued client, with the best service and support possible so you can focus on helping your borrowers achieve the retirement of their dreams.
Welcome back to the Industry Leader Update. Americans have more debt than ever before, which is especially dangerous for older Americans living on a fixed income. Today, individual debt levels and credit delinquencies are approaching pre-recession levels, similar to those seen before the great financial crisis and recession of 2008. Relief in the form of lower interest rates is increasingly unlikely, as the March Consumer Price Index report shows that the rate of persistent, not transitory inflation is accelerating. The Federal Reserve still has a long way to go before they feel compelled to cut interest rates. That is, unless the economy slips into a recession. Today, we're going to examine the economic headwinds that have resulted in higher interest rates and increasing pressure on Americans, especially seniors. Inflation and higher interest rates are a toxic brew that is pushing more Americans into financial jeopardy, as many are financing increasingly expensive everyday purchases on their credit card. March's inflation report, released last week, came in at its highest level since December. The annual rate of inflation grew to 3.5% in March, well above the central bank's target of 2%. Now, this may lead the Federal Reserve governors to grab their erasers for any planned rate cuts later this year, or even consider increasing the rate. If we continue to see inflation moving sideways, it would make me question whether we needed to do those rate cuts at all, said Minneapolis Federal Reserve Bank President Neil Kashari. Now, earlier this month, Federal Reserve Governor Michelle Bowman told attendees at the Shadow Open Market Committee in New York City, "While it is not my baseline outlook, I continue to see the risk that at a future meeting, we may need to increase the policy rate further should progress on inflation stall or even reverse." Now, presently, these hawkish viewpoints are but the minority on the Fed, but that could change. In his letter to shareholders, J.P. Morgan Chase CEO Jamie Dimon said the bank should prepare for rates as high as 8% or even more. Dimon notes the government's deficit spending is in effect acting as an economic stimulus, a policy that undermines the Fed's efforts to curb inflation. So how are Americans coping with today's higher prices? It's likely with their credit cards. Federal Reserve data shows that delinquency rates for consumer debt are climbing fast, approaching the levels that we saw in the years leading up to the 2008 recession. Does this mean we're on the cusp of a recession? Not necessarily, but the correlation is interesting. What is certain is if interest rates are increased, delinquency rates would certainly worsen. When it comes to debt held by Americans aged 65 to 75, MarketWatch reports the following averages for 2022. The average mortgage balance was $175,000, installment loans were nearly $29,000, car loans near $24,000, and the average credit card balance was just over $7,700. Those numbers are likely even higher today and will continue to trend upward. Case in point, the pre-tax income for Americans between the ages of 65 to 74 only increased 4.6% from 2019 to 2022, while inflation increased by 13% during the same period. Also in the last 3 years, credit card balances surged 47%, and nearly half of consumers, 46%, say that they're carrying credit card debt over month to month, all which points to the increasing pressures that older Americans living on a fixed income in retirement are facing. Now, what are your thoughts as a mortgage professional or reverse mortgage professional? Please chime in the comment section below. Also, if you would share today's video on LinkedIn, we certainly appreciate those of you that are doing that. We have a YouTube channel where you can subscribe and hit the notification bell. That way you never miss a future episode. And each and every week, we bring you the most recent reverse mortgage news curated for mortgage professionals like yourself. That's HECM World Weekly. You can find us on Apple Music, Spotify, Podbean, and of course, here at HECMWorld.com. Thanks for joining us, and be sure to return next week for more reverse mortgage news, commentary, and analysis you'll only find here at HECM World.